Hi everybody, I'm Steve McDonald and this is your Investors Daily Edge weekend wrap-up video. Let's start with the market. Despite the huge day on Wednesday, many analysts are very edgy about this market, and here's why. 21 of the last 26 days were up days. The S&P is up 3.5% in 1 month. The put-to-call ratio is at a 10-year low, and the VIX is at its lowest since just before the collapse back in 2008. The market sentiment is now 98% bullish, up from 2% bullish in March of 2009. Now, if you've been around as long as I have, and our guest today, Andy Gordon, has been as well, you know this type of run doesn't continue forever. When everybody's certain about the market, everybody is wrong. Keep the trailing stops I sent out this week in place and protect your profits. That's for the sound profit people out there. I think we have 8 that have hard trailing stops now. And the whole idea of that is to protect the profit that we have. This doesn't mean I'm calling for a correction. I'm not. It does mean I have seen this too many times before, and it may be a buying opportunity for us if market history repeats itself, which it always has. China, 11.9% annual growth was reported this week. That's unbelievable. 11.9 is so high it's off the charts. It plays exactly into my oil scenario I've been pounding the table about for the past 3 months. This growth rate means they are sucking up oil at an ever-increasing rate, and they are about to revalue their currency, which means they're going to be able to buy all imports, not just oil, at a lower real cost to them. That's what raising the value of your currency does. The revaluation of the renminbi, and that's what it's actually called, not the yuan, that's like calling it the buck, may mean they will start stockpiling oil before the rest of the world wakes up to the changes that are happening in oil supply. Trust the Chinese to act in their best interest. We should emulate them more closely on this point. Look at KBH and Lennar, KB Homes and Lennar, if you haven't already. Both have firmed up and look to be the leaders right now in that industry. Plus, the Home Builders Index is up again this month. It's a good sign. Now, a sign of the times. GM is no longer in the top 10 of the S&P 500. My, how things change quickly in this business. Shipping continues to have a huge week. UPS and DHL both reported huge numbers. That makes it a rail and air week for shipping, with rail traffic up 9%. The UNG trade I mentioned last week has had a nice bump up. Take a look at last week's video if you missed it. I think this is something you're going to want to do. Okay, this week's guest is Andy Gordon. Andy is a 25-year veteran of the domestic and international markets and is IDE's resident dividend income analyst. He's here to talk about how you can increase your income over what money markets and savings are paying now by as much as 6 and 7 times. Welcome, Andy.
Thanks for having me, Steve.
That's a heck of a claim, 6 and 7 times.
Well, you know, it is, but the rate of return you get from money market rates, it's less than 1%. You know, Steve, it's ridiculous. And for investors to be investing in that kind of rate of return,
it's crazy.
It doesn't even make your money back if you include
taxes
inflation.
Sure. By the time you pay and they're all taxable.
Yeah, so the real value of your money is going down. There's absolutely no reason for investors to put their money into those kind of funds or funds with high risk like chunk bond funds.
Okay, now let's back up a little bit. Tell me a little bit about your background in stocks and your trading service. How's it been doing?
Sure. Oh, it's been doing great.
What's the name of it?
Premium Income Service.
Okay.
And the portfolio is the Premium Income Portfolio. And it's doing very well. Not that I expected it not to do well.
Of course.
Of course. Of course. But, you know, a lot of my portfolio is made up of big, global, and growing dividend-paying companies. These companies have been doing great. I have one holding that has almost doubled. It's up to 96%.
How much of a dividend did it pay when you recommended it initially?
That particular one paid about 5%.
So they're earning 5% and it's doubled.
That's right. I have a company in my portfolio that pays 15% dividend.
Is it an individual company?
It's an individual company.
Not a trust or something?
No. And not only does it pay 15% dividend, it's making, around 45, something like 45% capital appreciation.
Okay.
So, you know, that's not bad.
Well, these are great numbers, but I know many of our viewers are listening to this and they're thinking, yeah, but can I afford the risk? Let's talk risk and return here. How long does a person have to hold this type of recommendation that you do?
Sure.
And what type of return can they expect on average?
Sure. Well, you have to hold it for at least a year. I mean, the first few months, after I make a
So
recommendation.
if a person
where I
looks at
invest.
this as a one-year CD type of
Something like that.
mentality.
Yeah,
So
1
if
year.
At least a year.
At least a year.
Well, if he holds
Yeah.
it longer, does the risk go down and does the return go up, or what happens?
Well, the return time, well, with the companies that I recommend, the risk definitely goes down because I only recommend companies with long track records of increasing their dividends or cash payment to the investors
What's a long
year
track
after
record?
year.
What does that mean?
Oh, 3 to 5 years.
Okay.
It can be longer, it could be shorter, but on average, that's a nice time frame to have for these companies. And for example, if you start out with a 5% dividend rate, and a company increases that rate by 10 to 15%, in 5 years, 5 to 7 years, your income has doubled.
Yeah.
And so
these companies actually increase their dividends.
Right, year after year, they increase their dividends. So that's your cushion. If you're getting a 10% dividend from a company after 5 years, or 15%, it depends what you start out at, then the company can dip. The shares can dip, and you're still way ahead. If they dip a lot, then maybe you're taking a slight loss, but your friend who invests in non-dividend paying companies, he's at a huge loss. You're at a very slight loss, if not still at a gain. So there's a big difference with these companies. It really does limit your downside. And as I said, these dividend paying companies, they have a reputation of being, big and boring. But what's so boring about getting, a return of, 10 to 15% a year? And as I said, so these companies, they haven't been in my portfolio more than a couple of years, and one that is getting 98%. I have 5 out of the 16 holdings in my portfolio are making for shareholders more than 40%.
What kind of income are they drawing on this?
Well, again, it's the dividend, the original dividend. I always I try to choose companies with over 3%
Right.
dividend.
Annually.
But annually. Now that's the original cost. They
Right.
go up, year after year. So after a few years, you're talking about 5 to 10 to 15%.
That's
And
a
of
lot.
course, the longer you hold it, the larger the dividend.
Now,
will
what if a
be.
person doesn't need the income? Can they reinvest the money in the stock?
Yes, and I recommend that they do that. It's not that you're throwing that money away.
You're buying
You're
more
still
shares.
taking the dividend, but you're taking it in kind. You're buying shares,
right.
and you're letting that money work for you because if for some reason the shares have gone down, and most of the time that's not the case. But of course, this is the stock market. Every now and then these companies do go down. You're buying cheap shares, and if they're going up, then you're buying shares with increasing capital appreciation.
Now, what do you see now that you like?
Well, I'm always looking at the domestic market. I'm always looking at foreign markets, and there's a lot of rumbling in Europe, in Western Europe, and in Greece. There's a lot of investors sweating over the high debt levels in Europe, but it seems to me that they're just looking at the old Europe. They're not looking at the new Europe or the emerging market, which is Eastern Europe, Central Europe, Poland, Hungary, Romania,
like Eastern
Latvia.
Europe.
I like Eastern Europe. And I include, let me just stretch that definition, I include Russia in that. I like it for a lot of reasons. First of all, their debt levels aren't what the high, extended, almost impossible to make debt levels they have in Western Europe. Even on the household level, not only public debt, but even on the private household level, the debt is much lower in these countries. And these markets are much cheaper not only than West European markets, but even non-European emerging markets. The Russian market, it's about, I'd say, 40% discounted right now. The Turkish market, about 20%. So these markets are looking very good to me, and they're growing.
Thanks so much for being with us today.
Oh, it's a pleasure. Always good to be here, Steve.
Where's your next trip?
I'm going down to Florida. I'm leaving next Tuesday. I'm going to be there for a little while. I'm going to visit the home office. We have a lot to discuss. There's a lot going on in the markets these days.
There really is. For everybody on the IDE team, I'm Steve McDonald. I want to thank you for being a part of this. One of Andy's reports is right below this screen. Take a look at it. Dividend income has always been one of the best ways to supplement your income. And with savings and money market rates where they are, you've got to do something. So thanks again. We'll see you next Wednesday.